Hello and welcome to the Self-Wealth Real Estate Podcast with your host, Luke Boiron. Today, I interview a very successful real estate investor named Cory Sperle. Cory lives out in British Columbia, but he invests mainly in Alberta. And he's been investing a very long time, buying his first rental in the early 2000s and investing through market changes, through oil crashes and all of that by investing in the prairies. Now he's syndicating deals, he's coached, he's hosted summits. He's very experienced, he knows what he's talking about. And the conversation today was really great. I really enjoyed it. I enjoyed learning from his successes and his failures, as we always do. So I hope you listen in and enjoy Cory's interview as much as I did. Thank you. Take care. Welcome to the Self-Wealth Real Estate Podcast with your host, Luke Boiron. Today, I am interviewing Cory Sperle. Cory is a very experienced real estate investor, so I'm really happy to have you here. Thanks for coming on, Cory.
Well, thanks, Luke. It's nice to be on your show today.
So to start, Cory, tell me about how you got started in real estate or kind of what you did before real estate.
Yeah, so great question. I got started late, like a lot of investors. I didn't get into real estate till I was in my late 20s. I grew up as trade school. I became an electronics technician, instrumentation technician. So I had, a lot of high-paying jobs, but no real ambition and no goals to really, do anything with investments, right? And at that time, no one my age was investing in real estate. It was nothing that anyone talked about. It was just something that, nerds or rich people did. In fact, like maybe 20% of my peers actually owned a house at that point. We didn't care. We were just perpetual renters. It's a very different dynamic than today. So I got started doing that. And then it was around 2003, 2004. No, it was actually earlier than that. It was 2001. 2000, I bought my first residence and I became an accidental landlord. I did a house hack. So I rented out the basement and I learned, well, this is actually a pretty good idea. This is paying a large part of my mortgage. I really need to look into this. But before I could really get going, I started working overseas. So I went to the former Soviet Union with my trade job. It was like winning the lottery at the time. I was making a lot of money and I wanted to keep investing, but I didn't know how. I didn't have the experience. I had the money. I just didn't have the experience or the time. So what I ended up doing was partnering up with other people, and learning how joint ventures worked. At the time, Alberta was just getting going. So I started to co-invest in Alberta and things really heated up, as you know, probably from 2003 to 2008, right before the big crash there. So I did quite a few deals then. I did single family deals, a couple townhouses, duplexes, single family. And then I eventually moved into multi. I bought my first multi actually in 2008, right during the crash. So it was even during that point, it was kind of a very slow and steady pace. I didn't go nuts. I was kind of doing one deal every 6 months, but that was kind of how I got into it. Obviously, like a lot of people I read, Rich Dad, Poor Dad. That was kind of what, what opened up my eyes a little bit. And I've been doing it ever since. So
interesting. Yeah. Rich Dad, Poor Dad. For me, the book that really opened up my eyes was Don Campbell's The Acre System.
Yeah, that's another really good one too. Canadian based too. So it was a lot more easy to relate for sure.
It was specifically about buying a bunch of rentals. And I remember, the lady in the story had something like 30 properties. I was like, what? That's possible? Opened up my mind to the possibility. And I know Rich Dad's done that for a lot of people, opening up their mind on what can be done. So where was your first, where did you grow up? Where was your first, your primary there that you rented out? Was that in Alberta as well?
No, so I'm Saskatchewan born and raised. So Saskatoon is where I was living. That's where I bought my house. I worked in the uranium industry. I worked in the uranium mines there, which is actually a pretty cool job. You'd be surprised. I actually quite enjoyed working as a instrumentation tech in the mines. It was week on, week off. I got a lot of time to read and study real estate and enjoy my time. So yeah, grew up in Saskatchewan. Yeah, went to school in Moose Jaw, took my trade school there. Like I grew up in a very small rural farming community, so I mean, real estate wasn't anything that was really talked about. Real estate was super cheap. In a lot of those places, it's still fairly inexpensive, very affordable. But I had, very humble upbringings. I didn't, I was just basically, I went through school. I wanted to do something like techie trades wise, right? I never thought I would have an interest or desire to do anything with the real estate as a business. But that turned out to be the complete opposite.
I kind of always wanted to do real estate.
Yeah. Well, a real estate family, you kind of were born into it, right?
Yes, I can see your my dad's book on the shelf behind you.
Fabulous book, by the way. It's awesome.
Powerful Real Estate Investing in Canada. So I find that's an interesting comment, the small towns, because I find when I look at small town real estate now, there's a lot of renters in these small towns, even where there's more affordable housing. Was that the same, 20 years ago?
There was quite a few rentals. So in the town I was from, Saskatchewan, I was kind of compared to the Maritimes, where it wasn't wealthy. Like, it wasn't like these oil towns where you see people have a lot of money. People were very humble. They didn't earn a lot. A lot of the houses were, small, these 50s style, these old, really tiny houses. But yes, a lot of people rented. A lot of people were struggling financially on social assistance. That's what I remember growing up. I don't remember people living in big fancy houses in my town. I mean, if you had a 2-story house, you were rich, right? Like, maybe the town mortician, I think he had the nicest house. But no, you're right. There's a lot of renters, and I think the demographics have largely moved away from small towns into the larger cities. So a lot of these towns are really struggling right now. But a lot of them are having a resurgence with immigration. A lot of immigrants are actually coming to these communities and reviving them, which is really good to see. Right? Exactly. Yeah.
Can't afford the big cities right now. They're very expensive.
Totally.
Okay. So Alberta was your place to mostly co-invest, and then you got into some multifamily stuff right around the time of the crash. Now, I'm curious how, in your viewpoint, how was the buildup in Alberta and the time when the market was changing in 2008? How does that compare to the way you see things right now?
It's crazy. Literally before this call, I was pulling up assessments for homes I used to own in Alberta. Okay, I'll give you an example. The primary residence that I had sold in 2013 is still worth the exact same today, 10 years later. And the house I sold, and the second house, is worth the same too. Now, keeping it into context, my only experience with housing before I actually moved to Alberta in 2005 was, I have a brother. He bought a house in 1998. He sold it 2 years later. I think he paid like $90,000. He sold it for $80,000. So, in my mind, it's like, this isn't something you do to make money. You were lucky to get 1% appreciation per year. Stuff just didn't go up by 10% a year, 5% a year. It just didn't happen. Mm-hmm. Like, if someone told me that, I would be just like, no way. I had heard about booms in Vancouver, but even then, Vancouver wasn't really that hot, right? It was just kind of starting in the early 2000s. But, having gone to Edmonton in 2005 to 2007 is when the buildup really started to happen. And I saw the house I thought I overpaid at 200, so I'd go to 300. So I'd go to 400. So I'd go to 450 in 2 years, which is exactly what kind of Ontario and British Columbia has been doing for, almost 2 decades now. And to experience that, it was truly shocking. I got overconfident, like a lot of investors did. It's like, man, this is easy. I got a HELOC, so that provided the seed capital for my first 2 apartment buildings that I bought with my own money. But looking at this now, especially where I am in BC, comparing the price points now, like, we've got a decade in Alberta with almost negative growth with rents and appreciation and valuation. So, to think that couldn't happen in other parts of the country is a little bit naive. I know there's a lot going on. I know it's like different demographics, but when I was growing up, Alberta was always the rich cousin to Saskatchewan. Yeah. But now, I was doing demographics this morning comparing Saskatoon and Edmonton. It's cheaper to buy something in Edmonton than it is in Saskatoon. And rents are about the same. Even though incomes are significantly higher in Alberta. So there's some really affordability things, but there's some really strange things at play. But yeah, long-winded answer, but to answer your question, yeah, I was not used to that build-up. And I think if I got a gift like that handed to me again, I would handle it much differently today.
Yeah, I was just looking up the population of Canada in 2000 was right around 30 million. And now it's around 39 million. So how much of that is immigration? That's really helped feed the real estate market. We just stopped building enough. That's the biggest issue. But it's interesting to think of that because immigration has been, I feel like, really on the tip of everyone's tongue lately. It's been big in the news. The federal government's talking about it. So it seems a lot of people are discussing immigration levels and making sure that we can house immigrants and all of that, because they've really just let more people in than we can build houses. So,
yeah, it's been a real. I hear what you're saying, and it's really been a heated debate, especially politically, ever since this inflation thing has come up and affordability has come up. It's really been in the spotlight. Housing has really been in the spotlight, and it's interesting because all you usually hear about is the supply side, right? You don't hear about the demand side. So maybe this is a conversation for another day, but I'm sure this is one we could talk about for a long time.
Yeah, I don't mind the demand side or like the immigration. My concern is, how do we build enough houses? And I like building. I'm, small scale, trying to build some infills. I built some coach houses. I add units to houses. I add units to apartment buildings. We took a 12 unit and converted it to 17 in the same footprint in Welland.
Yeah.
Added 5 units legally there. I like adding units and doing it. It's just the government doesn't make it easy. All the rules, yeah, they make it very, very difficult to do that. So,
yeah, not an NIMBYism for sure.
Yes, for sure. And just they add so many costs to everything. So 2008, you bought your first multifamily. I hear the market didn't do too well in 2008 in Alberta. So what was next for you?
So 2008, it was interesting because I had done a joint venture, two joint ventures with multifamily with someone else who had more experience than I did. So they were able to, show me the ropes. So I learned how apartment buildings were valued differently than single family, based on income and not just like comparable sales. So 2008, I actually went and bought my first 12-plex in a small town, which was the town I was from. 2,500 people, and it was be known as the BRRRR strategy today, but we didn't call it that then. It was value add, but it was, I don't know if I can swear on here, but it was a piece of crap building, right? Literally everything needed to be done. I paid literally $29,000 a door for it, so very inexpensive. But in 2008, I learned, there's never a perfect time to buy or necessarily to sell. I mean, I bought apartment buildings in the worst markets like 2008. I bought them in the hottest markets in 2014. So it's very deal dependent. And I found that, certain times it may be easier to find stuff, but you never know when the deals are going to land. So when this 2008 deal came, I had to make the decision is like, do I want to go for this or do I want to, curl up into a ball and be scared and, while the market's crashing and everything else. And I decided to go for it, even though I had just started a new job, just had a brand new baby. The building was 500 kilometers from my home, and I had no property manager. I had no idea how I was going to renovate it. I had no idea how I was going to rent it. Literally, it was baptism by fire. So, I thank myself for taking that step, because I definitely wouldn't be where I'm at today, but it definitely paved the way forward to more buildings. So after the crash, as you know, in Canada, it didn't crash that much. I mean, Alberta bounced back fairly quickly. Like, it wasn't like Kelowna. Like, I live in Kelowna. This market got clobbered. Like, prices only recovered in 2015. But Alberta, they recovered pretty fast. I mean, by 2010, values were already back up to where they were. So they hadn't lost a lot of ground. But it depends where you are. I mean, a lot of people have houses in Alberta. They're still worth less today than they were in 2007. So it really depends on where you are. Absolutely. But I bought my first Edmonton building in 2010, and then I went on to doing joint ventures with raising capital in 2012.
Nice. Yeah, I think your point on there's no right time to buy something, I think it's extremely valid. I think it's not just the time in the market. I think your time is almost more important than the time of the market. Even if the market's at the peak, if it's the best time for you as a person to buy, if you're in the best financial position, if you're in the best experience position, that might just be the best time for you to buy. There's no perfect time, but I remember looking at properties in Windsor. I remember looking at a 30 unit that was like, 70% vacant. And I can't remember exactly, but it was something like $30,000 a door. That's now, if that was fully renovated, probably $200,000 a door or something now. But I mean, I was still in school. I had no way to buy that, no way to renovate it. It would not have been a good time for me. Let alone, I think, what was vacancy rates were, 7-8+%. I forget what it was, but quite high compared to, 0.5%, 1% in a lot of cities in Ontario now. So it was not a good time for me regardless. And it doesn't really matter if it was a good time in the market. I probably could have gone bankrupt anyways. Even if the market was going up the whole time, you can still go bankrupt if it's not buying at the right time for you. So, yeah.
Well, at an experience level too, right? Because maybe if you didn't have experience or, someone who was helping you out, like I passed on a lot of deals early on. I got them under contract, and I don't know if I just chickened out for whatever reason. There was at least 3 buildings I didn't buy. And for years I was like, man, I could have been rich. Why didn't I do this? But then I realized I just wasn't ready. How I didn't know how to handle vacancies. I didn't know how to handle, cash calls from investors, these kind of things that inevitably come with the territory, right? And nothing really trumps experience. And I think now, like, especially now going forward in real estate, I think you're going to see that. But I love your comment about Windsor. What I was just saying, in 30 a door to 200 a door, what's that same building now worth in Detroit, 40 kilometers away? It might be a good deal there, maybe not. Like, does buying a building in Windsor today make sense? For some people, it may be. Like Quentin D'Souza, he's an expert on, cash for keys strategies in Ontario, right? I would not dream of investing in Ontario because I wouldn't have a clue about the rules and regulations. It would take me a long time to get up to speed and figure that out. Whereas I've done very well in my niche, but it's taken me 2 decades to get there. Yeah. Right?
Absolutely.
So.
Yeah. Yeah, I think the timing doesn't matter as much. But one thing just earlier I want to jump back to is you were saying you learned how multifamily properties were valued differently than single family homes on comparable sales. Can you explain a bit about how multifamily properties are valued?
Yeah, sure. So generally speaking, it's tied to income. So what they do is you take the net income. So it's basically your gross income, your rents, your your pet fees and laundry and all that. You apply a vacancy factor, usually around 3 to 5%, whatever the city is, and then you subtract your expenses. So then you get a net income. So what you do is you apply a capitalization rate to the net income to get your price. So example, in Edmonton, it's about 5.5%. So if your income's something like 100 grand, you divide it by 5.5%, gives you a purchase price of around 2 million. Now, there's a lot more to that formula, of course, but just generally speaking, what I really liked about that, and the eye-opener for me and my mentor who taught me, was he said it's known as the multiplier effect, or the rosebud, or there's a bunch of different ways you can describe the multiplier effect of every dollar that you can raise rents is $200 in value. So if you get a $100 rent increase across 24 suites, it's about a $500,000 lift to the property. And you just couldn't do that with single family. And I literally watched this guy and others from 2002 to 2007 just go absolutely bananas with this. Like, they would literally buy a building, raise rents, and then recycle their cash into another building, recycle their cash into another building. Now, this was before any restrictions on CMHC funds, any rules. It was literally the Wild West. So I was literally watching people just become extremely wealthy overnight. And I'm sitting here, playing with a couple of duplexes and townhouses. Wait, it doesn't take too long to figure out what you should be doing, right? And that was the real eye-opener for me. Just seeing the fact that you could, you could improve the property. You're only raising rents to what the market will allow, because we don't have rent controls, in my markets, which if you raise your rents enough, you're just going to be empty, right? It's not like Ontario at all. So you have to play within the confines of the market. But yeah, once I learned that the value that you could create quickly with multifamily, I didn't look back.
That's awesome. Okay, so what are you doing these days?
Yeah, so today I've always been kind of a very slow and steady investor, usually buying a building a year. I started doing joint ventures in 2012. I think I've done about 8 of them since. I think I'm on my 13th apartment building now. So basically what I do is I just raise capital, mostly from people that I already know, family, friends, repeat investors. So we usually pool our money together. We'll buy a building, I'll optimize it, and then we'll usually sell it, in the 5 to 10 year mark. Now, our formula in the 2000s worked very well because we had really high appreciation. Interest rates were really low. Rents were going up steady. So it worked really well. You could easily double investors' capital in 5 years. But that's changed now. It's a lot more difficult. We're in a higher rate environment. We didn't see the appreciation that we did. So now I'm extending my deals to more around the 8 to 10 year mark, which I think if you're buying a multi, you should be committed to 10 year anyway. I'm not a big fan of this, big BRRRR value add immediately. It can work in certain circumstances, but my go-to is buy and hold. It always will be. But the big difference between this year now and what I did before is I'm starting to scale up a little bit more, because I'm finding that as I started to do podcasts like this, I started to do summits, nobody had ever heard of me. And I think you told me that the last time you and I had this sat down for this. It's like, man, it's like, how come we've never spoken? I've never heard of you. I never dreamed I would even do a Facebook post, let alone do a podcast. So a lot of people now across the country, know who I am. They're reaching out to me and they want to invest. But I've only ever had a handful of available opportunities with the deals that I've had. So I'm scaling up now. We're doing, I'm partnered up with someone else. We're going to be doing a limited partnership very shortly here. We're going to be launching that early in 2024. So we're raising, millions in capital now to buy larger buildings, 10 million plus. So that's the goal going forward. We're just trying to, hash out all the structure. But at the same time, there is a certain amount of urgency, because I feel the market conditions in my markets, at least, is primarily in Edmonton, is absolutely perfect right now to invest. So I'm really motivated to do that. And yeah, that's going to be the goal for next year, Luke.
So the limited partnership, is that going to be specific to buying one property, or are you going to be trying to buy multiple properties within one limited partnership?
Yeah, that's always the $1 million question, right? What comes first, the cash or the properties, or the property then the cash? I've seen it done both ways. I've seen people raise a lot of money, but I'm not a fan of that methodology, because then you're really under pressure to go find a deal, right? The strong advantage that I've had in the way I've always done my business is no one ever has a gun to my head to buy a building. I was very content to be patient and wait till the right deal came. Sometimes it'd be 2 years after filtering through 200 and 300 properties. Oh, wait, okay, here's one. And then my partners instantly knew it was a good deal and they were on board.
Yes.
No, if I raised, $10 million and I'm out, well, man, now I got to buy something, it would create a lot more stress.
I agree. I mean, it's a little bit different if you're consistently buying properties like every 3 months, so there's going to be more opportunities. But when you're looking for just those excellent deals and you don't want to move on just, the regular stuff you find on pipeline, you're waiting for really just the right opportunity. Then yeah, I think that method of raising money after you find the deal is the right way.
But on that same account, yes, but on that same account, you got to have your ducks in a row. Like you can't, land a 100-suite building and then close on it without having done any of the work up front.
Yeah.
So we're consistently doing capital calls with our investors, almost on a daily basis. Our legal team has already pretty much set up the framework from our LP, to the point now where that as soon as we get the deal that we're now offering on several at the same time, that as soon as we land the right one, we're able to pull the trigger and fit all the pieces together as smoothly as possible. I know there's going to be some hiccups, but there's a lot of prep work, when you're going at this level. And for me, it almost differentiates between, I never really considered myself a professional investor. I was always considered, this was always kind of a part-time thing for me. But this step is going from, I don't like to use the word average, but everyday investor to professional. It's a completely different level. There's completely different responsibilities that go along with that. And, a lot of people have done this way faster than I did. They'll do an LP within 5 years of starting real estate. I'm already on year 20, almost year 24. But I don't feel like I've missed out. I think I've done it this path for a purpose, and I feel comfortable with the pace that I've been going for sure.
And can I ask, is there a reason you chose for the GPLP structure versus any other structure? Is there anything particular that you liked about it?
That's a great question. And it mostly boils down to guarantees. So in the past, every deal that I've done, I'm not even afraid to admit that I hate CMHC. Like they're not a partner. They're not your friend. They're an arm of the federal government that multifamily investors have almost been coerced into joining this cult, right? Like I did all of my joint venture deals were conventional. I did 5-year financing, 75% loan to value, easy peasy. I could do that all day long. My investors never had to sign a guarantee. CMHC forces your investors, even your silent partners, to sign a guarantee in a limited corporation structure, which is what I'd always did, right? One company, one unanimous shareholders agreement, very cheap, very easy to set up. So we just did a deal now where we bought an 18-suiter in May of this year, and we had to do that. We had to get our partners to sign guarantees and all agree on a unanimous shareholders agreement. So you have, different lawyers going back and forth trying to hash together this agreement. And it's like, I said to my partner, this just is not going to work. Like, we need the flexibility of an LP. We need to shield our investors from the guarantees. We need to make this more flexible, because once you do a USA agreement, you sign in blood pretty much, right? It can't be changed. So the biggest reason is we needed more flexibility, but for me, it was the guarantees. I think I envision the fact that, I would still do deals similar. Like, let's say we were raising $4 million. I'd probably still find 4 investors with $1 million, right? Then 40 investors at $100,000, right? I would probably still do it that way. But I think the LP structure, even though there's cost, is definitely the way forward.
Yeah, no, I think that's a great reason for it, and definitely serves the purpose you're looking for. A little bit of a slightly selfish reason for me asking this, but how have you found securities laws exemptions in terms of talking to people about investing in potentially an LP, about I'm offering memorandum exemptions for are you using the friends and family, business associates, that kind of exemption? So can we talk a bit about that?
Yeah, actually, I just did when I did Real Estate Resilience 2023, just about a month ago, I actually hosted the guys from Graham Barr, and that was our entire discussion was on LPs and exemptions and rapid firing as many questions as possible, because, you've seen this yourself. You could go in any Facebook group and find, 20 people soliciting funds for their deals illegally, right? So, you really got to be careful of what you're doing today. And a lot of, especially with, the high interest rates, a lot of these people that were midway through their project, now they can't get the funds to buy out their partners, etc. And there's a lot of stuff that's not going good, right? And the exemptions one, I like to use the accredited investor is pretty much a no-brainer as a non-starter. Accredited investor criteria is different in different parts of the country, but generally speaking, you have to make $200,000 a year or $300,000 as a husband and wife. There's 150,000 exemption in BC. So that means if you have 150,000 to invest, that you're smart enough to know the value of that money and not lose it. So that's kind of the starting point for investment that I have, is you're generally safe with that amount. But it comes with a lot of sign-offs, right? Like, independent legal, independent accounting advice, etc. Securities law is one of these things that I think they're only going to clamp down more and more in the coming years. And I think for any investor, you really have to invest the time and the money to be on the right side. And I've been lazy in the past too. I've gotten people to sign stuff, but nothing really bad happens unless, somebody's not getting paid. And then questions start to get asked. Then the phone starts to ring, and then, oh, okay. So it's one of these things that, some people it's been like, how does that go? You beg for forgiveness versus ask for permission. And it really has to be the other way around.
You definitely see some, especially kind of newer investors who are very brazen with raising money in ways that are almost like, some of them operate much more in gray areas, but some of them are very clearly soliciting, funds for securities against.
Yeah, and I don't really understand that. I don't understand the urgency of why you have to tread into gray areas. And a lot of people are soliciting funds for deals and they've never even bought a single piece of real estate. They have no track record behind them either, which is something, again, I strongly recommend against. You want to get the funds, you want to do some deals on your own to get your feet wet. I've seen it pulled off successfully a couple times, but even the most successful of these funds, I'm sure you followed the same circles of stories that I do. Even the most well-known ones in Canada that everyone thought were bulletproof, they're doing cash calls to their investors now. Things aren't as rosy as they once were. So I think this is critical. And if you're a newbie, it's like your chances of success are very low if you're not taking your time and doing this very carefully.
Before that one in Saskatoon that blew up, in part because they were essentially paying other investors by raising new money, and when they got clamped down by the Securities Commission, they couldn't raise new money to pay their old investors, and they weren't making enough money in the business. So that's an interesting. Yeah. Some people are good at real estate but bad at raising money, and some people are good at raising money but bad at real estate. And you kind of want to find someone who's good at both. You know, they need to be able to raise money for the deal, but they also need to, you know, if you're an investor looking to invest with someone, they also really need to know what they're doing in terms of real estate. You have some people who are very good at promoting themselves. They raise a lot of money for their stuff, and they're not good operators, but they're really good at appearing to be successful real estate investors, and then they can raise a lot of money that way. And that's definitely a more dangerous person to be investing with as a cash investor.
Yeah, you nailed it. I mean, early on this year, I did a post and an email and some videos about it. I said 2023 is going to be the year of the experienced operator. Banks are looking for experience. It used to be just net worth. They didn't care if you had experience. Now the number one thing that lenders are looking for is your track record of experience, right? So I mean, that can't be stated enough. You got to have the background. But the thing that really is really confusing to me that I see this everywhere. You don't see invest with me because I'm an awesome experienced operator and I know how to generate returns because I've lost money myself and I know how it goes. You don't hear that. You hear the guy saying, hey, I know how to raise $10 million. I know how to raise $20 million. Here's a raising capital event. Raise capital. That's all people talk about is raising capital. And to me, I'm thinking to myself, okay, well, what do you do once you raise the capital? It doesn't mean you're necessarily going to do anything with it. Like, are you going to generate a return with it? Like, what's your main motivation for doing that? For any extent,
when you raise capital, you have to return it at some point.
Well, and any experienced investor I know, that's not their primary thing that stresses them out. It's looking for high quality properties. It's acquisitions. So, I mean, if your biggest worry as a real estate investor is how you're going to raise the money for your deal, you really need to reevaluate how you're doing your business. I mean, you can ask anybody who's experienced. They have probably 10 times more capital coming to them than they can deploy in the market. They don't have an issue raising capital, unless it depends on what they're doing. Maybe if they're a REIT or they're public, it could be different. But people really need to focus on the experience portion first and the raising capital second. That's just my 2 cents.
Yeah, it's funny because I've always been focused just on the real estate side, and raising money. It's not that I hate it. I just it's never something I want to think about. So it's something we've recently started doing. We're kind of borrowing on first mortgages for our flips now because we have 20 flips on the go at a time, and we're going to be raising money for some of our multifamily properties. In the past, I just didn't want to go through the effort of trying to speak to a bunch of people. I'd call up someone I knew who had I'd either do the majority of the deals were just done with my own money, or occasionally when I got a great opportunity, but I didn't have the money at the time, I'd call up someone I knew who had enough cash to do it. And, we partner up there. It just kind of made it easy on myself. Now I'm trying to do a little bit of a better job of raising money. But I mean, at this point I've bought and sold 850, 900 houses. It's not, I'm raising money before I do my first deal. I've done a lot of real estate. I know what I'm doing. And now I'm actually trying to let people know about that a bit. So
it's a very different conversation to have with someone about raising capital, like from them giving you their hard-earned money, to it is about how good you're going to do on this property as an operator, right? It's a very different conversation, and I'm finding, just like you, even a year ago, I was not comfortable having these conversations. I would do these webinars, and that's what everybody wanted to do. I'd do a survey. Hey, if you're interested, fill out the survey, and I'd have 200 people fill out the survey, and I'm doing these calls to people, talking to them about how good this investment is, and they're just willing to give me the money. But I'm like, oh, really? It wasn't like I wasn't expecting it, but it's because when you fund deals with your own cash, it's a lot, I would say, easier, and it's preferred. I know a lot of people Christian Spielvogel, prime example, he's self-capitalized. He's never raised capital. Yeah. And I think most investors would agree with that. If I didn't have to raise money, I probably wouldn't. I'd be content to just be self-capitalized. And for the most part, I think sophisticated investors can do that. But there's definitely a place for raising capital if you think of it in terms of, what can you do for other people? What's the best way you can do that? Especially when I see a lot of these, I mean, like you just mentioned Epic in Saskatoon, right? A lot of these Ponzi schemes that literally blew up, people losing money. Then I realized, man, yeah, I mean, I kind of owe it to these people to share what I've been doing for myself. Not just with education and showing people tips, but actually getting returns on your money. because, why wouldn't you? You got to kind of think of it that way too.
Yeah. It's kind of a disservice to not, if you're able to offer the same returns in a much safer manner, to not give people that opportunity. So
yeah, disservice, or maybe you're being selfish. You're being selfish by not sharing the spoils. There's different ways you could look at it.
So you mentioned the Resilience Summit. Can you tell me a bit about that? Are you guys doing it again next year? I know I spoke at it last year, and I believe you do a bit of coaching. Can you talk a bit about that as well?
Yeah, so we did Real Estate Resilience Summit in October of 22 was when Elizabeth Kelly and I first started doing it. And that was when, the real estate industry first really kind of hit a downturn, and investors were struggling. And we wanted to find a way that we could reach out and help by getting a bunch of people together who were not afraid of the market. They were still out, they were still doing deals and sharing what they were doing, right? And it was a tremendously successful event. Well, thank you again for your spot on the wholesaling and wholetailing. I still remember that. God awful house you showed on that PowerPoint. But anyways, I digress. We did very much the same thing this year because conditions have been very choppy. This year we wanted to have more representation from across Canada, which we did. We had investors speaking from pretty much all the provinces. So it was great for delivering value to people. I don't know necessarily that we're going to do it again. I found this year was a lot on my plate, especially considering I'm trying to launch my LP now. I also found there was a lot of summits. Like last year, there was maybe 5 or 6. This year, there was like 50 competing summits going on all at the same time. And Elizabeth and I never intended to make money on this. We've never made a dime off these summits. It was always a way of giving back, right? We kept our ticket price just low enough to cover our costs and not even cover our costs. So, I'm not closing the door on it completely. We definitely could do it, but it's not something that I'm planning to do at this point. But I'm pretty sure Elizabeth will. But to be continued. You never know. But coaching, I started to do coaching in 2021, just after a series of requests. When I first started to go online doing Facebook, you mentioned Don Campbell's book. RAIN was the go-to place for real estate education. There was really no one else out there. So I was a really big contributor to my RAIN space, which was the Bigger Pockets forum at the time. And I was posting on there constantly about multifamily. And there was a trend, a pattern of people from British Columbia buying multifamily in Edmonton. And they had the same story. It's like, hey, I bought this building, in this area and with this person, and this person's managing it. And I had probably 5 different people private message me after some of my posts. And I quickly realized that they were following really bad advice. They were buying in horrendous areas, high vacancy, full of squatters, full of drugs, you name it, not having a clue, didn't know how to operate it. The management company they had was also running the buildings into the ground. So people were getting hurt, and they were getting hurt bad. So then I thought, okay, well, I have to start sharing what I knew. So I started doing webinars, just sharing some tips. That's how it started. And then I started to do some more one-on-one education. And then the last couple of years, I've just been doing a program called the 6 Pillars, which is group coaching. So that's been awesome. I've had like 70 students go through that program. But now I'm kind of winding down my coaching business. I still have a couple of self-study programs out there, but I'm focused more now on syndication and doing the larger deals. That's going to end up chewing up most of my time. But the education piece was great. I love giving back. I love to see, people that aren't going to step on the same landmines that I did or you did. Because, you know what that's all about.
Well, this is perfect timing because a big part of this show is learning from the mistakes of successful real estate investors. A quote I had hanging up in my house growing up said something along the lines, it was attributed to Socrates, it's something along the lines of, a smart man learns from his mistakes, but a wise man learns from the mistakes of others. And what I'm trying to do on this podcast is to have people share their mistakes, and hopefully we have some wise listeners who can learn from them. That being said, Cory, let's move on to the segment of the show where we talk about our best and worst deals and what we learned about them. So to start, will you tell me, what is the best or your favorite deal that you've ever done?
Yeah, best and favorite would be two different deals. But if I think of it in terms of like pure profit, I did a BRRRR in 2017, which was a very down part of the Alberta market. It was a almost 50 suiter, 48 suiter in Red Deer that was actually a burr. I negotiated a dynamite VTB on it, only 10% down, and bought this almost 50 unit building for $3 million, so about 62 a door. And within 8 months, we had the value up to almost $5.5 million. So we did a complete refinance, pulled all of our equity and then some, and that was definitely the richest deal. I did 2 or 3 similar deals after that when interest rates were still low. Now, those deals would be harder to pull off today, obviously, in today's environment, but that was probably the best deal on profit. I've done some other multifamily deals. One other one in particular that I did in the near the college in Edmonton, which was a 5-year buy and hold. That was probably my most satisfying deal because I followed a plan and I executed basically, start to finish as per the plan. So those are the 2 that stick out the most for the best.
So
sure.
The 48 unit in Red Deer. You went from $3 million to almost to around 5.5 on the refi.
Yeah.
What did how much were the renos, or what did you have to do to get there?
So usually there's an interim financing cost that you have to factor in. That was very low because the VTB was really low interest rate. I can't remember exactly. It was something like 3%. And we only did it for 8 months. So there was almost no cost. We did end up spending about $1 million on the upgrades, right? So at the time, I'm not sure, that would probably be around $20,000 a unit. That renovation would be a lot more expensive today. So basically we bought at 62 a door, all in, we were probably around 90 when we were done, and we refinanced around 130 a door. Wow. So yeah, that was a pretty big lift in a short period of time.
So yeah. What lessons did you learn off of this deal?
Oh man. So that one, I learned to partner up with someone that has experience doing these type of projects. So I had originally planned to partner with someone else. They got cold feet. I didn't know exactly how to pull it off because I had done a smaller scale lift on the small town Saskatchewan property, but nothing of this scale. Like, one of the buildings had foundation issues. I didn't know how to fix foundation issues. There was all kinds of potential landmines, but I partnered with someone who had more experience than I did, and we worked together on this deal. So I can't take all the credit. But it was, I negotiated this deal for almost a year. It was on MLS. Nobody wanted it. It was like 85 a door. And it was under contract several times by other people before I finally got it. But once I did.
2 lessons.
Yeah. Persistence.
And partner with someone experienced if it's not something you're entirely comfortable doing yourself. I think that's great. I mean,
exactly.
It's quite impressive to have turned over, pretty much all the units in that time period, 6 months. That's a quick reno. That's a lot to manage. That's impressive. It's hard to get contractors to do anything quickly nowadays. So.
Well, yeah, and then I think we ended up firing 3 contractors, general contractors. We ended up going through 3 on-site managers. So, people that see these burrs and think, oh, well, if the after repair is 100 and I'm buying it at 80, I can spend 20. Well, no, because your pain and suffering is worth something. To buy a stabilized building and buy and hold where you almost do nothing and start making money from day one is a far cry from a project like this. So yeah, they're not for the faint of heart. Huh?
Have gone through multiple GCs and multiple on-site supers. The reason you got rid of them is because you guys were keeping a close eye on it. And that's something
exactly
you're going to do, because this could have gone wrong if you'd stayed with them. One that wasn't working out for both the on-site supers and the GCs. That's a quick way to lose out or have the project drag out significantly longer, all of that. So I think that's a great
for sure
that people can learn from this as well. That being said, let's move on to the worst deal, or at least your least favorite, whichever you prefer. But usually it's financial. What's the worst deal you've ever done?
Well, thankfully I have a couple deals in mind about that. But really, a bad deal isn't a bad deal unless you sell it at a loss, right? Like, I'll talk about one. I did a 24 unit in Saskatchewan, and this one dragged on. I literally had negative cash flow. I turned over almost every single unit. The local rental market in Saskatoon. I bought this building in 2016. Okay, I paid probably a little bit too much at the time, around $115,000 a door. It needed a lot of work. I was planning to do a 5-year buy and hold. The market had 5% vacancy. The market had dropped from 2014. This is when the oil crash happened. So we were only at the start of the downturn, which would end up being a 10-year downturn. I had no idea it was going to go that long. So this is a story that I share with investors in multifamily because I think it's very important to illustrate what can happen and what I've done to change ever since. And so I had a sufficient reserve fund, or I thought, I had 5% of the building value, about 130 grand I had saved. Within a span of, I want to say about 18 months, I blew through all 135 grand plus 250,000 of my own money, just turning over units every time someone left. So they were on year leases. As soon as the leases ran up, in 2017, the citywide vacancy after being 0 in Saskatoon was 20%. That is unheard of in Saskatoon, Saskatchewan, a city of 300,000. You can go back 50 years. That has never happened. It's always been like 5% vacancy, 2 or 3% a year increases for 50 years straight. But the oil crashed simultaneously. So did uranium. So did potash. Like oil and gas. Literally everything hit the tank at the same time. And in 2014, 2012, before that, we had a massive buildup of purpose-built multifamily. So there's a bunch of new multifamily product that had in-suite laundry, underground parking, all the amenities. They were charging $2,000. Overnight, they dropped the rents to $1,000, which is what I was renting for. So I instantly lost all my tenants to these bigger buildings. So I would basically take a unit, someone would move out. I was charging $1,200 or whatever it was. I have to spend 10 grand, 15 grand fixing the unit, re-rented it for $950. Okay. 6 months later, that person, did some damage, moved out. I had to spend more money on renovations. I re-rented it for $900. That guy moved out, same thing. Re-rented it for $850. At one point, I was even renting 2 bedrooms for $795. So this went on for years. Like, this wasn't a blip. This was literally 2017 to basically the pandemic, right? Or near the end of the pandemic. So incredibly stressful situation, as you can imagine. I ended up reaching out, thankfully, to someone who was more experienced than I was for help. And what do I do here? Because they had gone through this before, No one talks about losing money. When you do a joint venture, all you talk about is how much money you're going to make, right? Look how great this is going to be. You don't talk about the what ifs. What if this goes beyond 5 years? What if there's a cash call? How long are you going to, be in this deal? In this kind of thing. So the help I asked for was really helpful. In the end, I was able to navigate things around. I reached out to my investors and I was honest about the situation. And thankfully, the building turned around. The good news about this story, we were able to get a really low CMHC loan, less than 2%, refinance to pay some of those payables back. And now the market in Saskatoon is just on fire, literally. Like, there's 0 vacancy. I've raised rents 40% since that point. So now we're cash flowing like crazy. We have a low mortgage until 2026. So the building is going to deliver a very solid return. Right. But it was a very, very, very rocky. And this wasn't just one building, Luke. Like, I had 3 buildings at the same time that were doing this. I had one was mixed commercial in Edmonton that was even worse because the pandemic gutted all the commercial space with the rent abatements, right? Yeah. So it was a very, very long struggling period. And I share this with the new investors in multifamily in particular. So there's a couple lessons on this one that I can share.
Yeah, let's talk about it. I think a lot of investors on Ontario have never really experienced this. So, yeah.
So number one, large cash reserves. Like, no matter what, like 5% of the purchase price isn't enough. I would say even 7.5%. So on a 24 suiter, you probably want. Now this would apply to Ontario as well because things could change, right? You're still going to have expenses turnover. You have a lot of older buildings there too. Yep. A lot of deferred maintenance. Your roof and boiler, things like this that you have to keep into account. But on a 24 suiter, you probably want to have 250,000 at least in reserves, and you want to have almost like separate pockets of reserves. You want to have a reserve set up. These are for the main items, like if the roof goes, if the boiler goes. And if we don't use these, great, we'll pay them back at the end. Yeah. But that should be set aside. So this is how I do deals today. So does it diminish your return a little bit at the end? Possibly. But it sure saves you a lot of headaches on a cash call. Yeah. Second thing is you want to be open and honest with your investors as possible. And you want to obviously raise money and have those cash reserves. But you want to have a really solid exit strategy, or better yet, a multiple exit strategy. Like a lot of these deals I see, these syndications, the first thing I ask when someone's raising money is, when do I get my money back? When does this deal end? I think the divorce is more important than the marriage. Like, I always think there has to be a way out of the deal at year 5, year 10, whenever there's a capital event, maybe when the mortgage is renewed, refinanced, etc. So the other thing that I'm doing besides the reserves is my deals are longer now. I'm telling investors, don't plan on getting any money back. Don't get any, nothing distributions. You will not see this money for 10 years. Are you still in? If you're still interested, yes. And the third lesson is, I don't go as high leverage now. Like that was 75 loan to value. Nowadays with MLI Select, you can go absolutely bananas with 95% and 50-year AMs, which you pay down no principal. That makes for a very uncomfortable conversation 5 years later with your investors if you're underwater and you're facing what do they call it, a margin call, where you have to, pay down your loan by 200 or 300, 400 grand and you don't have it.
Yeah.
Right? So you want to have some pay down, you want to have significant cash reserves, and you want to have a longer time frame. Those are my 3 big takeaways there.
That makes sense. Okay. Some great lessons there. All right, let's move on to the final segment of our show, where I'm going to ask our final questions. First of all, what has changed about your approach to real estate investing with your experience?
I've just been a lot more cautious. I used to be like super aggressive, going after deal after deal after deal. But as my underwriting abilities have improved, it used to be hard. I used to fall in love with every building I'd see, right? So nowadays, my underwriting's a lot better. I can quickly filter up properties I want or don't want, or even have a chance of fitting into my portfolio. So I'm a lot quicker at analysis, and I'm a lot more selective on the properties that I am bringing in, for sure. That's the main one.
It is funny, the falling in love with properties. There's certain buildings I just love. My partner on a building I have in Brockville, we own just a single family down the street, and we were driving by. We're like, let's just drive by the property, and you drive by it, everything looks good, and then 10 houses down, 5 houses down, on the corner of the street, you see this apartment building. It's kind of U-shaped with a courtyard in the middle. And we both go, wow, that's a beautiful building. I'd love to own that one day. Well, a week later, someone on our commercial team sends it over to us and says, hey, this building's on the MLS. We go, that's the building that we saw a week ago. We're like, what a beautiful building that is. And I do. It's my favorite building. It's a 24-unit concrete construction.
Nice.
No elevator. Just, really, really well built, solid building. They just done the roof. So, and, rents at half of market rate. Plus we got a BTP on it. I love the building. My favorite. But yes, so I get what you mean though, but sometimes we fall in love with buildings a little too easily.
Well, in concrete too, economic life is a big thing, right? Because, buildings in Ontario can be built in the 20s, right? Ones in Alberta are, 50s and 60s. These wood frames are getting old now. Yeah. So concrete, you're going to have that building for a long time.
All right. So, question 2, if you could go back in time, what's one piece of advice you'd have for a younger you?
Oh man, that's a good one. Everybody wishes they got that chance. Besides watching Back to the Future, right? I would obviously get started earlier, and I'd reach out for help earlier. There wasn't a lot of mentorships available, people that you could bounce stuff off of. Today, there's a lot of people that you don't even necessarily have to pay in a lot of cases. Most investors are happy to share stuff with you. And like watching podcasts like you're doing now, just watching these tips, I would have invested in myself a lot earlier and, learned what real estate was all about. I would have did a house hack when I was 20, not when I was 30, right? I think that would be the biggest difference.
Yeah. That's a great advice. Get started if you can, right? Take action. That's earlier. All right. And lastly, what is the most overlooked or the most overhyped investing strategy right now?
Wow. Overlooked and overhyped?
Well, one or the other. Yeah.
Well, for overlooked, honestly, right now it's buy and hold, because everyone is it's all about instant gratification now. Everybody wants to do nothing gets flipping, Luke, because I know you flip, but a lot of people want to do the BRRRR. They want to do the flip. They want to do the very quick equity, get the big jump, the big massive piece. But to me, it's buy and hold. It's it's not a get rich quick scheme, but it's a get rich for sure scheme. It's the long proven path. But on answering the same half of that question, the overhyped one, for me, is definitely the burst strategy. I mean, people try to force the burst strategy into a buy and hold building or house, right? Just simply because. And I think it's because of the promise that they're going to return investors cash right away. And then everything that you earn after that is an infinite rate of return, which it actually isn't, right? But that's how it's sold to people. Yeah. So that's definitely the most overhyped.
I think that's a great way of looking at it. Yeah, the flips are interesting because I think both for flips and for long-term holds, the way the market is right now, there's opportunities in them. And
oh, totally.
The things we've been able to do is it's surprising we're able to buy flips at better prices because we don't have the same level of competition as we used to. So the flips work that way. But I agree with you. Flipping for me is an active job, whereas long-term rentals are, as long as they're not actually passive, but they are the long-term strategy. They're the retirement strategy. They're the, kind of be able to. Setting them up is very active, but once you own them, it doesn't need to be nearly as active. So the flips are the active way to bring in revenue to then be able to buy, the multifamily, the apartment buildings, commercial for the long term. So,
and you flipped almost 1,000 houses, and you don't even have gray hair. I mean, that's very surprising.
Awesome, Cory. This was great. Thank you so much for coming on. If listeners want to find out more about you, find out about your syndications, where can they find you?
The best way is just through my website. I have a contact form there. It's altynequities.com, ALTYN, equities. You can find me, on Instagram and Facebook too, at Cory Sperle. Easy to reach out to me there, social media. I have a YouTube channel too. It's not like yours. It's Multifamily Naked Truth. Not quite what you're thinking, but I've only got like a dozen or so episodes. I do an episode every 3 or 4 months. So maybe I'm going to have you on for this story about this 24 suiter of yours as well. It's nice to compare notes with other multifamily investors. So,
all right, it's an interesting one. I love this one. So yeah, I'd love to be on it. All right, Cory, cool. Thank you so much for joining us. I really enjoyed it. I think people will get a lot of value out of this. So thanks so much for joining, and we'll talk.
Yeah, and great to connect again, Luke. Appreciate it.